Ashima Goyal, the professor from IGIDR and advisor at EGROW Foundation, to take over. She is chairing the session, and we have a special lecture from Ricardo Rees, professor at LSE, a dear friend. We were together at Harvard. I was doing my postdoc, and he was doing his doctorate. And we used to be in the same computer room all the time in the basement. So with that little brief friendly introduction, I hand over to Professor Ashima to conduct the session, please.
Thank you, Charan. Thank you for the invitation. And it's wonderful to have Ricardo giving a talk here. I'm familiar with your work, Ricardo, because I teach macro at IGIDR, or used to at least. And I think you've done really nice work in the NKE field. Interesting general equilibrium discipline plus relevant frictions. And I think the real world has been throwing macroeconomists one challenge after the other. And COVID-19 is the latest example, this explosion in public debt and the monetary fiscal coordination it requires. So we are really keen to hear you. And also, I hope you will give us a little bit of the emerging market perspective. Yeah? Thank you.
I will try.
Yeah.
Thank you very much.
Would like to allocate 3 questions in the middle or all questions at the end? What is your preference?
I'm going to say, unless it's clarification questions, I'm going to say at the end. If it's a clarification, just something what does X mean?
People will be writing on the chat, so I'll take them up in the end.
If not, then I'll try to speak for roughly 30-ish minutes, 40, so we'll have 20 minutes at the end to have more of a discussion on the topics as opposed to clarifications. But because I structured the talk such that different bits are going to come together at the end, it's better if the debate happens at the end. Otherwise, in terms of vice versa. Well, anyway, thank you so much. It's a pleasure to be talking to your group. And as you said, these are in some ways exciting times to be macroeconomists, because as usual, exciting times to be a macroeconomist are challenging times for the world. And these are very challenging times for the world in terms of the gigantic, of the consequence of the pandemic, as well as and especially on the gigantic recession through which the world is going through. Unlike 2009, the world is now in a recession and has been in a recession for several months. Pretty much almost all areas are growing well below what they were just a couple of years ago or a year ago. And that has in many ways put a stress on the global economy and the functioning of our economy. Now, I am not going to, in this lecture, talk about why we had a recession, what is that recession looking like, how are we going to recover from the recession. I could, but I won't. I mean, I'm not, what I am going to be talking, but I'm happy to discuss this at the end. What I am going to be talking about is the public debt. Why did I choose to talk about the public debt? I choose to talk about the public debt because, as an academic, it is right now, or better than right now, in the next 12 to 24 months, the way we think and act on the public debt of a country is going to come into serious question. We are going to enter what I mean a crossroad where different paths can be followed. The public debt will be a challenge. This is not to say, and as you will see during my talk, that I'm saying that we should privilege paying the public debt versus other macro goals. Quite on the contrary. What I am saying is that the challenges that the public debt rises for fiscal policymakers are going to be intense. Understanding them and their trade-offs requires, if not new ideas, at least an understanding that these are not the same challenges that afflicted us in, say, 2017 or 2015, for that matter. The COVID-19 pandemic and the developments in the last even decade or two, as I show you, are going to change the way we have to think about what the public debt and how to deal with it. So why is that? Fact number one, and this comes from the IMF Fiscal Monitor, if you simply look at the average across a big sample of advanced economies and a big sample of emerging market economies, subject to data availability, what's in those samples, but it's really representative. What you see is that right now, at the end of 2020, the public debt to GDP at the end of what the IMF likes to call the Great Lockdown is at historically high levels. We are already above the level on average, if you look at the major economies, of what we had in terms of debt in World War II. And the emerging market economies, even if they borrow half of what advanced economies do, also for them, we are already at record high levels. This is true both if you look at total debt or private debt, meaning it was both private and public debt that have increased over time, and especially that had a very large increase, as you see here, in the last year. There's been an enormous increase in debt following what had been a couple of decades of a rise in debt, or certainly one decade where debt had already been on the rise across the world, whether advanced economies or emerging markets, and then there's a dramatic jump up. So the state variable, the state of the world, the stock of debt is at a higher level than average. Immediately, let me tell you, this was not in any way a mistake. Quite on the contrary. Increase in the public debt was needed and desirable because during 2019, it was important to increase public spending without raising taxes. Here again, from the same IMF report of the State of Public Finances, what was the additional spending as well as the foregone revenue and tax revenue that came from tax breaks across different countries, which was of a very large fraction of GDP, even though with very large dispersion across countries. And noticeably, advanced economies look at the scale of these axes much larger than the ones that we saw in emerging markets, and in turn, much larger than we saw in low-income developing economies, matching what, in some ways, the fiscal capacity of these different regions. Why was this needed and important? For two reasons at least. First, a social insurance, you may even want to call it solidarity principle, which was that we were afflicted by an enormous shock, a pandemic, that affected the entire aggregate economy, but especially affected some people much worse than some others, depending on the sector you worked in, your age, your occupation, and other variables. Well, in such a circumstance, when we have a shock that has very disparate impacts, it becomes sense to say that, well, ex ante, we couldn't anticipate that some people are going to suffer so much more out of this unexpected event. Therefore, insurance is the right word. But because, at the same time, this is an aggregate shock, simply private insurance could not deal with it because it requires the nation as a whole not to simply take from the fortunate to give to the misfortunate, but to instead take for the future where we expect to be post-pandemic to give to the present where we are needing these resources to keep our consumption levels, to keep our livelihood, to keep poverty at bay. So it makes sense that it is the government, that is the country as a whole, that borrows and then distributes it in a better or worse way, depending on the country, towards being able to alleviate the poverty, sustain the consumption, try to insulate people from the enormous risk that this pandemic came. That's the first point. Second, there's a reason to do this, which is a macroeconomic reason, if you want, which is that this pandemic was characterized by lockdowns, by the fear that people had, a justified fear, as well as the government position of engaging in work, in production, in trade. GDP doesn't fall from trees. GDP is the result of all of us getting together, working, transacting, innovating, creating, and selling. Now, when we observe a shock that prevents us from doing this, again, in very heterogeneous ways, you end up with some people, some sectors having essentially no revenue. Imagine a restaurant or a cinema that ends up with almost no revenue after a very strict confinement, if you have a very, very strict form of confinement. But on the other hand, other sectors, such as potentially teaching or lecturing, where it can be done imperfectly but somewhat online, having instead a fall in revenue or sales or productivity or output of more like 20% instead of 100%. Well, in these circumstances, though, because lecturers go to restaurant and restaurant owners take lectures, you have that the system of pipes that is an economy where water flows across sector, across people, and that generates the aggregate welfare and the aggregate GDP that we produce, is all of a sudden subject to all these blockades in a series of different pipes. These propagate through the economy, come with inefficiencies, come with bursting pipes that then have negative consequences for the many months that follow, there is a very strong macro argument to not just in a recession, but especially in a recession like the one we have now, characterized by a breakdown in trade relationships, that we borrow from the future and in doing so are able to save the macroeconomy, as sometimes was told. So there are very good reasons to have very large deficits and thus accumulation in debt. How did this happen? Or on top of there being good reasons for the deficit and increase in debt, across especially developing economies, but also in part some emerging ones, what we saw was that the central banks were gladly, if you want, roped into this process. What do I mean by that? By buying some of the government debt and offsetting that by borrowing from banks, by crediting the deposit accounts of banks at the central bank in order to do so. That is, if you want more directly, and this is actually how it works, central banks went out and went to the banks who had bought the government debt and bought it from them, paying them with deposits in the central bank. Why were central banks gladly roped into it, as I wrote here somewhat provocatively? Because the last decade, here on the right, I have expected inflation in the United States extracted from a model, and the story could be told with many different indicators, but expected inflation in the United States has been relatively subdued and especially had a negative trend from 2 to something like 1.8% here. That is, inflation at anything was either anchored or trending down. Well, in a situation in which inflation was trending down, facing a gigantic crisis, the central, which would lead many central banks to expect inflation to even fall further down, it made sense for the central bank to engage in monetary stimulus, i.e. in enlarging the size of its balance sheet. Well, but then there was a coincidence of desires in that the fiscal policy wanted to borrow large amounts and the central bank wanted to buy large amounts of that debt, and controlling both inflation as well as welfare and output coincided such that we saw the combination of these two. Okay? Now, why though? So we have this gigantic increase in public debt, partly financed by the central bank in the last year. Why though was there, has this not led to any stress? And indeed, you could even look backwards and why was the public debt increasing now for a few years? The reason was what had been happening in the recent past of real interest rates. And so let's understand that towards transition to what maybe happened in 2021 and 22. I've told you what happened in 2019 and 20, or 20 and 21. Sorry, not 19. 2020 and 21. Let's talk about how we got there towards finally going to my 21, 22. What had been observed over the last decade in a very striking way, but over the last 20, some economists may even argue 40 years, although there's reasons to be a little more skeptical, is that real interest rates had been following quite significantly. Again, certainly since 2010, Japan, US, Europe, across countries taking out trends, maybe even before 2010, even less so. If you go before 1990, I think it's much more debated. But real interest rates had been falling a lot. Now, real interest rates, these are the real interest rates on government borrowing. What it means for the real interest rate to fall, what it implies, is that governments were now paying less interest rate in order to borrow. Thus, this excess borrowing, both in the last 12 months, as well as in part in the last 120 months, because we saw the increase in debt predated the crisis, has been very little costly. It weighs very little on the public budget when it comes to raising the revenues, the tax revenues, to pay for the debt. Why? What happens once to this already lower R, you superimpose the crisis of the last year? Think about the global supply of savings and the global demand for investment. I say here global so that we think about the intersection between the two. That is, that there isn't a gap accounted for by saving abroad or investing abroad, if you want. Let's think about this as a model of the world. Understandably, high interest rate means people want to save more. High interest rate means that you want to invest less because it's more expensive to do. Our star here in the point A is where supply and demand equate each other. What happens during a crisis like the one we had in the last 12 months? Well, first, assets become less safe. Because of this excess borrowing, the safety of government bonds, the trust that they will always pay you for sure, that no defaults will come, gets diminished, both because the stock of debt went up and because with the recession, the ability of governments to raise that revenue goes down as well. Even, by the way, treasuries, the bedrock of the international financial system, the US treasuries, saw some pressure, saw some cracks, and there was some difficulty the US government had in selling them back in March and April. And now, over the last month, their price has been following, their interest rate has been increasing. So even those have turned out not to be appreciated as being all that safe. Well, if assets become less safe, then what you have is that being able to save less on assets, on financial assets, we end up wanting to save more in actual real investment choices. And that shifts the supply of savings to the right. It may indeed shift so much that we end up saying, oh, all we can do is save in real investment projects rather than financial assets. And that leads even to sometimes a potential for a dynamic inefficiency, as it's sometimes called, where we actually invest too much because there's so much savings to fund investment. But that's the first reason why sometimes we worry about in crisis there being too much savings. A second reason is the reaction to risk. In response to the risk that the pandemic raised for my health, as well as simply for the state of my job, or even for the fact that I'm concerned about the recovery or whether I'm going to be more effective relative to you, it is natural that people facing this risk will engage in saving more, accumulating a larger buffer stock of savings to respond to the greater uncertainty. Again, this leads to an increase in the supply of savings. We want to save more. Third, even after the crisis is over, even after assets are back and risk is now back to normal, it is insofar as you can't nowadays open a magazine without reading an article that tells you about how the post-pandemic will be in a new world where some sectors will appear, some will disappear, some will boom, some stagnate. It is natural to think of people as perceiving there being more idiosyncratic risk. I don't know if in this new world where imagine indeed all education happens in lectures, whether I'll be the one giving the lectures now to 2 million students, or whether I'll be one of the many lecturers who lost their job because there's a much better lecturer who can now teach the 2 million students, driving me out of a job, say, if we move to online lectures forever and to many students. So there's more idiosyncratic risk. Again, with this more idiosyncratic risk comes an increase in savings. Therefore, what this crisis does at first, what 2020-21 does, is by shifting supply savings to the right, lead us to a point like B, i.e. a low real interest rate. Note again, coincidence of desires, exactly when the government is borrowing a lot, it's paying very little to borrow. And so everything seems fine. And indeed, in the last 6-9 months, even as all these countries borrowed so much, this has weighed very little on their public purses because at the same time, how much they were paying to borrowing was declining steadily and steadily. Now, there is another point here. And this diagram of a crisis is a famous diagram in economics because it is the diagram that Lord Keynes 90 years ago used to think about the Great Depression. What he was worried about, or at least certainly the way we interpret it nowadays, he wasn't quite saying this in the terms I was using, was that, look, if the supply increases so much to the right, if people get, he called it animal spirits, they get spooked out, they start saving so much because of this perception of risk, then it may end up being that the actual real interest rate needed is a very negative number. But in that case, the fact that the nominal interest rate can't fall very much, can't fall, say, below an iota level, some level around zero, then we may end up that because interest rates are stuck at zero without falling nominal, real interest rates are stuck at minus inflation. And so the economy ends up instead in a point like C, where we have an excess demand for investment relative to supply of savings, because the interest rate is no longer actual to adjust. It can't adjust to this level. The R is too high relative to what the equilibrium needed. And we end up with a depression in the sense of excess capacity, where we have a very large gap between the desire for investment and the supply over here, okay, as a result of this shift. So, and that will be the depression scenario. What does policy do in that scenario? First of all, is this even realistic? Absolutely. Here is for the US, the UK, and the Eurozone what happened to savings rates in 2020. In the United States, in April, the savings rate went for a usual number around 10% to a record level, record since we measure this at the monthly level, 35%. People saved a gigantic amount. Even if you look at the year on average, the savings rate across these economies where we already have good data doubled during this period. This is the household savings rate. There was really an unprecedented rise in savings. Why, you may say? Well, because in these countries, the government, how can that be? How can people save when they lost some of their livelihoods, when the economy is collapsing? Well, because the government borrowed, sent checks to people, those people saved in their banks, those banks deposited the Fed bought the government bonds, and that was the equilibrium we've been in for the last 9-10 months. What is important in this is this part, the government, meaning following the Keynesian playbook, the playbook that we all macroeconomists have learned if they ever did a class in macroeconomics and how to avoid the next Great Depression. When you see a big increase in private savings, you match it with a big decline in government savings, such that national savings don't go through this. That is, you use public savings to move some of the green line back left, eliminate the excess capacity, and reestablish an equilibrium in which we don't enter a depression. Okay? So far, playbook, things work, interest rates fall. If anything, governments are pushing for them not to fall as much while having the room to do so in fiscal policy, given what had happened. Now, what if we look for the 2021-22? Well, and let me right away put that parenthesis. What if the saving was not for all these reasons, but rather was simply involuntary? Meaning, I wanted to spend, but the government locked me at home and didn't let me spend. Then you may think that a spending surge is coming. I accumulated all the savings because I couldn't go to restaurants. As soon as the government lets me go to restaurants, I'm going to go to a restaurant every day for a year in a row. If that is the case, a spending surge is coming, then government policy in 2022 is going to have to revert. And what was government savings is going to become government savings. Let me provocatively call it, if you think that this was involuntary savings, then you must think that a spending surge is coming, in which case you think that we should raise taxes massively in 2022 so that what we borrowed in 2020, we pay in 2022. It's both fair and it's in the sense that the people who got the big checks in 2020 are about to pay them in 2022, and it's efficient insofar as macro management goes for these reasons. What this meant for debt was, as I told you, is that because interest rates have been below growth rates in the economy, what that's meant, this is the difference between interest rates and growth on average over time, over long periods of time, but also here in the United States for the last few years. What this meant is that because we expect the interest rates are so low, many have started saying, what about R less than G? By which they mean, look, interest rates are so low now, if we lock in a 10-year interest rate at 0%, for sure our economy is going to grow more than 0% over the next 10 years. We will have to pay very little of what this debt is. The low interest rate means, I told you, that it becomes easy to pay for the debt. With this macro in mind, let's think precisely about the consequence of this R being less than G, and R being less than G, but also M stands here for R is for the interest rate, G for the growth rate, M for the marginal part of capital. The interest rate on bonds, because its excess savings is so low, lower than the growth rate of the economy, even if there's productive opportunities in the economy, and therefore the marginal part of capital continues to be, as usual, above the growth rate of the economy. Well, in that scenario, what are the implications of the debt arithmetics if R is less than G than less than M? Number one, insofar as the deficit is equal to the primary deficit plus interest payments, you have this famous one-liner given by these authors. You could run a deficit gamble. What does that mean? I can borrow a lot. If today the Indian government says, look, if I can borrow at, I'm going to make up a number, let's say 0%, just because it's simpler. If I can borrow at 0%, for sure, I think that the Indian economy is going to grow over the next 10 years by, say, a total of 30%, to use again a round number. Well, that means that if I borrow $1 million today in 10 years is going to be 30% less as a share of my income. As a result, I can run this gamble, meaning say, look, I will pay for this in the future, but the paying for it is going to be a very small share of my income in 20, in 30 years. And so I can sustain the spending splurge with a negligent increase in taxes as a share of income, because the million that I have to pay back in the future is going to be more than offset by how much I pay. However, this does not mean that even if a deficit gamble for one-time deficit is feasible, that you can do this persistently. If you don't, ignore the equations if you want, just focus on the words, okay? What happens if instead I want to spend permanently more? If, as in following this recession, we start spending more in the present as well as into the future? Well, you can sustain potentially higher present value of deficits insofar as indeed the interest rates on public debt continue to be very low. And again, here in my expression, low, government pays less than anyone in the private economy pays, which is what the marginal product of capital is, if R is less than M. Why? Because if that's the case, the government debt has, if you want, a premium, I may even call it a bubble premium, in which it says that the government debt is providing some services, people like it for its safety, for the reasons I told you earlier, and as a result, because of that, the government is able to collect some revenue just from issuing the debt, okay? Now, this means that you can do more persistent spending. You can't just spend any amount, as less than one would say. Rather, you can spend some higher amount because with a low interest rate, indeed, it lowers your debt burden because this difference increases when it comes to the debt. Now, this debt burden depends on not just whether R is less than G, but especially on this M is less than G, meaning it is the case that with a low interest rate or a high growth rate, you can spend more, but at the same time, as importantly, is whether you're discounting this more or less by what your marginal product of capital is. That is, it's both differences that will matter when it comes to evaluating persistent spending. In particular, and perhaps more clearly, the deficit to debt that you can sustain is given by this gap between the growth rate and the real economy. But if you try to have deficits in the future that are relative to debt, that are too high relative to what the G and R in your economy is, that is, if given a gap between your growth rate and your interest rate, you try to have a deficit that's too high, then you will end up defaulting on your debt. You'll end up with a sovereign debt crisis. And to note how big this is, given that today the most optimistic forecast of this gap is 2%, then you have that at most the US could run, talking here about the US, a maximum debt of, or a maximum deficit of around 5% of GDP. Well, the 2020 deficit is well above it, is already running at 17% of GDP. In other words, this fact that R is less than G allows you to run temporarily deficit gambles, which you may say countries have done, but this leaves you very little room for permanent gambles, meaning for having higher spending persistently for many years, because without needing to raise the taxes to pay for it by relying only on R and G. Now, but why, on top of it, why is it that this M, this R is bigger than G? Well, because public debt provides these safety and liquidity services, that it allows me the safe asset that outside of the investment that we were talking about. But that means that you need to also be careful about which policies may shrink this gap between R or M and G. For instance, if you, as I said already, if you spend beyond your peak, you will have a default, and that default comes with an explosion in your interest rate because your debt no longer will be safe. Likewise, if we have a remarkable amount, and perhaps more surprisingly, if we have a very aggressive provision of insurance, as perhaps you may say ex post we want to, meaning we want to help those more affected by the pandemic and less, and we should, but note that in doing so, we are raising the interest rate because it was that gap, that inequality that was in part leading to the low interest rate that we're observing. Meaning solving the problem of the recession, solving the inequality and its disparate impacts will have as a side consequence raising the interest rate and making the government have to pay more for its debt. Likewise, if you think about financial repression or even income tax changes, insofar as these may be good things or bad things, either way, insofar as they raise interest rate, they both help me get out of the recession, but they also make paying the debt harder. In other words, there is today sometimes a certain, how should I say, schizophrenia when you hear policymakers talk, when they say, I want to do this, redistribution, social insurance, stimulus, potentially default on the debt because I'm not going to raise taxes to pay for it, inflating the debt and others in order to stop being in a recession. And all of those, yes. Many of those things are ways to escape the depression, ameliorate the recession. But at the same time, it is said all of those come with raising the debt stock, but don't worry about it because interest rates are low and I don't have to do anything to pay for them. Well, no, and this is the schizophrenia. If indeed you leave the recession, if you avoid the recession, if you respond effectively to the pandemic, that will come with high interest rates, which then will make the debt hard to pay. If instead you say, no, interest rates are going to be low and I'll have no trouble paying the debt, yes, but then you're saying I'll be in a depression because that's what comes with the low interest rates. Either interest rates are high or interest rates are low, but you can't have your cake and eat it too. Okay? You can't say I want to do everything to get our economy out of the recession, to respond to the pandemic, and at the same time, this costs me very little. I don't want to worry about the public debt because interest rates are very low. Well, but if you succeed in getting us out of the recession, the interest rates will be high, and you have to worry about the public debt. Okay? If then let's take the good case scenario where we avoid a world Great Depression, we fight the recession, and indeed the interest rate goes up. Well, if the interest rate goes up and we have now a very large amount of debt, and now we have large payments on the debt, then what? What do we do? Do we cut spending? At least, and let me be here. Now I'm going to talk more about advanced economies, and I'll go to emerging markets in a few slides. There's an echo coming from, okay, thank you. Well, in the advanced economy, spending cuts seem to be very hard. Here are the projections of spending for the US. They've looked bad for decades. Nothing ever happens to change them, it seems, because so much of it is tied to healthcare and Social Security. What if instead we inflate the debt? What I have here for you is value at risk measures of how much can you inflate away the debt, 2, 3%, lower the debt burden, calculated at different points in time in the US. And the fact is what you see is that over the last 8 years, even before the crisis, the chance that you would lower the debt by more than 2, 3, 4% was very low. The probability was very low. Why? The reason was that in the United States, and this is partly true in Europe too, most public debt is a very short maturity. And so no matter how the inflation comes, with more or less variability, more temporary, more gradual, more permanent, if you have very low maturity of the debt, that debt cannot be inflated away. Why? Because low debt maturity is one that comes due very soon. The only ability to inflate the debt is for inflation to come before the debt matures. Well, but you can't have, if the debt is going to mature in a year, it's inconceivable that in advanced economies, inflation is going to increase enough in order to inflate a very large part of it. So what ends up being more likely for the United States, for Europe, for the UK, is that we'll have financial repression, as usually happens whenever there's a debt crisis. And financial repression is nothing but coerced government borrowing, forcing extension of the maturity of the debt, and forcing interest rates to stay low on the government debt, even as they're rising in equilibrium in the economy between savings and investment. Let me skip this just because, So financial repression, maybe what comes. Financial repression, the only point that was there is financial repression does not come for free. Financial repression, meaning the government forcing society to lend to the government to pay for the public debt, comes historically with gigantic distortions in the allocation of capital, with corruption, with often the poor saving more as the rich find alternative ways to save, not by lending to the government, but the poor are stuck with saving in banks who then are forced to lend to the government. A second consequence is, again, let me manage my debt well, is that when you end up with the government trying to deal with the debt crisis, not being able to spend, interest rates going up, real interest rates, is to tell the central bank, since you have an influence on nominal interest rates, then you become the debt manager. Your job as a central bank, given your power to print money, given your power to control interest rates, to affect interest rates, make sure that we can pay the debt. This is what happened after World War II all over across the world. The central bank was not about controlling inflation. The central bank was about controlling the payments on the debt, making sure that we can pay for it. What happened? I have here, for instance, for the, again, almighty United States, what happened after the 1940s and what happened to inflation as a result. A central bank that's a debt manager is a central bank that ultimately ends up with not only having a good equilibrium, inflation is low, but also a bad equilibrium, inflation can be high. It is a central bank that ends up having inflation unanchored. And this is what you saw happen even in the mighty United States in the late 1940s. As a result of post-World War II, the Fed becoming a debt manager, inflation shot up to 10%. It was only after the central bank stopped being a debt manager and was given, in the famous Treasury-Fed Accord in 1951, was given back its independence of being able to focus on inflation rather than on the Treasury's problem of debt management, that inflation came down and became the anchored inflation that we've come to know. Okay? So, if not R, then what? Spending cuts, unlikely. Inflating the debt suddenly and therefore not having a debt burden through inflation, unlikely. More likely, financial repression, central banks losing their independence, managing the debt, this leading to an anchored, very volatile inflation, which eventually, which comes with a cost that inflation would have. But how would a public debt crisis, or if you want, instead of a savings glut, an excess of savings, a lack of savings play out, especially in emerging markets? If indeed we have that advanced economies get out of the recession, but because of that, start paying a high interest rate. Interest rates rise, real interest rates rise, and we end up with a combination of financial repression and central bank debt management, both contributing then to less savings, a savings dearth. How does this affect emerging markets? Okay? This global equilibrium, which I spoke in terms of advanced economies, but think about them in terms of the world as a whole. A world with central banks that are not independent, with an RBI whose job is to manage the debt, not to control inflation. A world in which governments have trouble controlling their deficits. A world in which we resort to financial repression, tax on financial institutions, excessive regulation forcing the allocation of savings that allow me to indeed pay the debt, the public debt, but come with an unwillingness of people to save, a great decline in the amount of savings that we have. Well, that world is a world in which EMs, which, as I told you, had to start with smaller programs, are already suffering through lower growth. We're seeing that China notwithstanding, being the exception, we have that there is the IMF forecasting that because emerging markets had less of a fiscal cushion in order to be able to pay for the fiscal expansions, they're ending up with deeper recessions than the advanced economies. With deeper recessions comes more trouble being able to even raise tax revenues, and therefore fiscal problems hitting it for more. But moreover, what we know for emerging markets is that crises come with, this is a picture from the Mexican crisis of 97 or from the Argentina crisis of 2001, that crises come with when there's a dearth of savings, when the US, Europe, the UK starts absorbing savings to pay for their public debt, pushing for policies that repress, don't allow savings to go outside of their borders because they need to manage their public debt, with their central banks all out in managing their public debt. What we end up is with capital flows leaving emerging markets and moving towards the core, if you want, from the periphery, and also with emerging market banks falling into what's sometimes known as the doom loop or the diabolic loop, where the banks have to be the ones stepping in as foreign investors leave, back to the core country, and you end up having the financial sector, the banks, having to step in as the holders of the debt. Okay? Well, how do you fight these problems, these sudden stops, this dearth of savings? Well, use your dollar reserves has been the conventional answer to EMs. But already in the last 9 months, we saw cracks in your ability to use your dollar reserves to offset this. We saw cracks in that when the crisis hit, treasuries should have their prices rising as they're a safe asset, which means that your savings in dollars grow up in value exactly when you need them. That's why they were good insurance. That's why you save in dollars. You don't save in Argentinian pesos. And yet what we saw in 2020 was that the price of the dollars responded by falling. The exchange rate of the dollar was depreciated in the last few months. The price of treasuries fell at first in a crack. That is, as foreign investors, usual, for instance, in March, took money out of the treasuries in March and April, flew out to use their savings, they found that instead, the Fed had to intervene with gigantic QE, with gigantic assistance policies to prevent those dollars being worth less when they were needed. At the same time, the cost of those dollars, and a measure here of the cost of borrowing dollars is to look at the so-called cross-currency basis with respect to a bunch of different currencies, went up in March. And it was only through a very aggressive intervention of the Fed to the creation of new swap lines with the central banks, i.e. gigantic lending by the Federal Reserve towards the foreign investors, they were able to avoid a crash there already. Okay? That is, we already saw that in the last 9 months, the dearth of savings I was talking about, the need to manage public debt in these countries, the very large expansions in the core, in the advanced economies, already put gigantic stress over the emerging markets, which was avoided because the Fed conducted the policies that provided the extra savings, released it in order to be able to stop the dearth to emerging markets. But will this continue? Well, the answer has to be no if you think that the central bank stops being a defender of inflation, but rather, in the case of the Federal Reserve, becomes the debt manager of the US government. If the Federal Reserve becomes the debt manager of the US government, these things, these huge QE, these swap lines, which it did, will no longer be present in the future. And we know that what will happen is that what happens in emerging markets is that the saving glut, the saving absorption by the core in dealing with its public debt problem leads to a run from the currency in EMs, a run to other currencies, and quick inflation in EMs. In other words, and I'm sorry, I think I've spoken 5 more minutes than I was supposed to. Apologies for that in this introduction. We are in a crossroad in the next 2 years. Okay, public debt is high emerging from the recession for good reasons, like I said, and I've gone through how that worked. Secular fall in R, then we had a pandemic huge shock, inflation was stable, there was a confluence of policy goals. We went for public spending, let the debt rise, accommodate with monetary policy, lowering interest rates and higher debt. But we are going to reach an inflection point in the next 12 to 24 months. If the spending programs are too small, we risk a depression. But if they're large, it will raise the interest rate and will therefore make the public debt burden show its head. How do we manage it then? Well, the past R minus G bonus from the secular fall in R had already all been used. And moreover, cutting spending and inflating the debt in advanced economies seems unlikely. But then advanced economies will engage in a mix of financial repression, central banks managing their debt, and some enacting of inflation. For emerging markets, these actions will show as a dearth of savings. The cracks in the dollar and the treasury shows that already only through aggressive policy interventions was a spillover to emerging markets avoided. A crash can come sooner with a currency run that you may expect. And that's what I had to say. That's the crossroad. I'm not saying things are going to look very terrible, but I'm showing you why a non-issue, public debt has been a non-issue for 10 years, will become an issue and will come an issue with dangers, with policy having to deftly manage these different possibilities. Thank you very much. And I'll stop there and take questions.
Thank you, Ricardo. Thank you. That was a really interesting presentation, giving new insights into this often debated and discussed issue. But I just had a quick question that is it so easy to unanchor inflation expectations? There's all this talk about a new normal and that R is going to be low for, say, 20 years, and that's enough time to come around.
So let's distinguish there between the R, the real interest rate, and the inflation. Okay. First, on the claims that the real interest rate is going to be very low for a very long period of time, note that those are predicated on people saying we're going to be in a deep recession for many years. But as I said, if we have a robust recovery, R will go up. Indeed, in the last week alone, what happened to the real interest rate R in the US? It shot up by a few basis points again, 20, 30 basis points, so not crash. Why? Because there was optimism given the recent numbers by the traders on this debt that indeed 2021 is going to be a more robust recovery than was initially anticipated. Growth, avoiding the repression, comes with high R. This is my point, Ashima, of you can't have your cake and eat it too. You can't say we're going to avoid the depression and the R will stay low. No. Those forecasts of low R come with forecasts that output is not going to grow very much. But if the growth comes, and we all wish it will come with low R. A second related point raised by your question as well is, but what about inflation? To go from R to I to real interest rates to nominal interest rates, we have to think of what happens to inflation as well. There, what we have seen is that central banks have much to pat themselves on the back and to congratulate themselves in the following sense. We have gone over the last 20 years, in some countries 35 years, in some countries 5 or 10, central banks have extremely successfully been able to control inflation in many countries. As a result of having inflation very stable for many years, people responded optimally, smartly, by saying, I'm going to stop paying attention to inflation. Sometimes 2.5%, sometimes 1.5%. How does that matter for my pocket? 99% of the population, zero. If inflation is stable and anchored, I don't need to pay attention to it. And as a result, people stop paying attention to inflation. And you see that when you ask people in surveys about inflation, where they care about it, what inflation is, people have been living as they should, kind of clueless about it, as they should in the last few years. As a result of this capital, capital of trust, meaning I don't pay attention to what you do in the central bank because I trust you always deliver stable inflation. Over the last 12 months, central banks have collected that trust, have used that trust to say, look, because people expect 2%, I can do very aggressive monetary policies that because inflation are anchored at 2, this is not going to result in a lot of inflation. Because people believe that, yes, the RBI is doing lots of things, the Fed's doing lots of things, the Bank of England, but inflation is going to go down to 2. And when it comes to controlling inflation, if people expect it to be 2, even if the central bank does lots of things, the inflation ends up being close to 2 or going back to 2, even if it exceeds it or goes below it for some period of time. Okay, so it is that capital trust central banks that we've used and why we have not seen higher inflation in spite of, or inflation or deflation in spite of all the big shocks in the last few years. That is why I raised the question of, though, if the central bank stops being an inflation targeter, stops saying they will deliver inflation, but instead becomes an agency in charge of managing the public debt, and therefore is willing to let inflation divert out and stop saying our target is 2%, that capital trust can be lost. People start paying attention to inflation. Inflation has become unanchored and inflation follows. And that was the scenario that I was saying of why this, if this happens, then we have that problem arising.
Yeah, there are a couple of questions from students. So just to take them up with a slight spin, one question is about savings dynamics in emerging markets being very different from advanced economies.
Yes.
I would say that savings dynamics in Asia, you tend to be high saving countries compared to Latin America.
So the question here on the same,
that reference to your story. And the second is about, go ahead. You want to take?
Let me answer the first question, if that's okay. Yeah, let me take the first, then you answer second, because I'll answer shortly. Look, this was a simple representation of, as I told you, the world. Okay. Part of the reason why R was so low was that indeed Asian economies save a lot. They became more important in the world. And as a result, we ended up with R's very low because the green was so right. That is all correct. And that's the last 10, 20 years. And Asian economies were extremely important for that. But what we're asking here is what's going to change? What I told you is that during this pandemic, the increase in savings happened a lot in the advanced economies. So from this green to the dash green, it was not so much about what happened in Asia. The data that I have, at least, although it's still preliminary, doesn't show a big change in savings in Asia. So the extra savings was really in the advanced economies, which is right. That's number one. Number two, when we talk about what's going to happen in the future, and like I said, if we recover from the recession, R goes up because we go back here, then we're talking about the dis-savings in both emerging markets and advanced economies in terms of the public dis-savings. Okay. When we talk then about whether we're going to have a spending spurge and others, again, note we're trying to offset here the advanced economies. So again, we're talking about whether in the advanced economies it goes. But finally, what you need to ask yourselves then is, where do you think savings, which have been very high in Asia, how will they change over the next 5 to 10 years and therefore interact with this crossroad that I talked about? Now, forecasting is hard, of course, certainly 5 to 10 years when it comes to savings. But ask yourself, 10 years from now, do you think that Southeast Asian countries, or just not forget Southeast Asian countries, will have a higher savings rate than they have today or a lower one? Not today, sorry, than in the last 10 years. Let's not talk about 2020. Well, it seems economic history teaches us, although, the future does not have to be the same as the past, that as India, as China, as so many other countries in Asia grow, they start saving less. Savings rates tend to fall as countries get richer. Moreover, savings rates are already extremely high in these regions. I think I am more comfortable guessing that in 10 years, savings rates will be lower than higher than what they are today in Asia. If that is the case, what will that lead to? Contribute to the rise in R. Asia was crucial to explain why R has been falling in the last 20, 30 years. Asia will be part of the story of why R will revert and maybe increase in the next 10 years, raising the challenges that I put in my talk.
Right. So the second question is about the quality or the kind of government spending. One of the criticisms after the global financial crisis was there was not enough fiscal spending, and as your M greater than G, or a lot of infrastructure with externalities, etc. So if the quality of government spending is such that it increases productivity, job creation, and so on, can it make a difference, sustains growth?
Absolutely. Absolutely. If you're spending pushes, there is an answer to this crossroad which says, look, you never hit the wrong fork, which is if growth rate is high. If growth rate is high, even as R grows, if G grows even more, no problem with debt. Even as R goes up and we avoid the recession, if long-run growth G goes up, no problem, let it come. Okay? So absolutely, a higher G as opposed to my focus on R would mean that the crossroad is a non-problem. Yes, there'll be a crossroad, but hey, it doesn't matter very much. However, and so if public spending can raise G, absolutely it should do it. But by the way, it should do it in 2021. It should also have done in 2019, pre-COVID. Should have done in 2010 and 2005. It's not like the crisis meant that, if it's going to raise growth, you should do it. You should do good investments. Now, note though, so having said that, I always find it a little dangerous to stop there for the following reason. Saying that if growth goes higher because of something I do, I stop facing problems, trade-off policy challenges, is a little bit like me saying, well, if I win the lottery tomorrow, I don't have to worry about anything in my life and in my budget. Sure, of course it will. That doesn't mean it's not completely responsible to just say, well, I have a magic way here to win the lottery and therefore stop telling me to worry about anything at all. Forget the public debt, anything at all. If I'm just going to grow faster, I can also worry less about inequality, also less about poverty. I worry less about the climate insofar as I can use taxation and others to address them. Most problems in economics get solved with higher growth. So question that you have to ask if you say that is, how confident am I that the government spend that I can do will raise G? And I think that, from the perspective of politicians or policymakers, you always have to have some confidence. You do think that some forms of government spending are going to make the world better. And I think you will. But you also have to have the humility to recognize that often there are long lags, there are mistakes along the ways. It is very hard work to avoid bad investments, bad spending, corruption, all kinds of barriers. But if you can do them, absolutely go ahead, but be humble as opposed to saying, well, this will solve the problem, so I don't have to worry about it.
Yes, it's, but I think as a policymaker, you have to have some optimism, otherwise you just can't function. Problems are too much. So then there's a question about this G minus R in India. So we've had relatively high levels of debt compared to Asian countries, but much lower than, say, the West. But I think, and this is, I'm saying that I have seen that in the period when we had higher growth, unfortunately, and interest rates were low, this was the 2000s, but unfortunately that was also a period when the primary deficit was rising. It was pro-cyclical. But still, you had a fall in growth rate in debt rate successfully. But in the 2010s, because we had something of a double deficits and some outflow of capital, extra conservative macro policy. So very high interest rates and a fall in growth, fiscal conservatism, huge attempt to decrease deficit did not work. Debt levels stayed more or less constant. So now the government wants to position towards, say, if there was this overreaction in these periods, in the second period, now a more balanced policy where you try to keep interest rates lower and have a mix of policies that increase growth. And, so I don't know if that will, but
no,
general problem in emerging markets too for this G minus R is the volatility. We have much higher volatility, country risk premium and so on. So, and there, I think the issue is that you need more intervention to stabilize various assets, even exchange rates. So we have a system of intervening to reduce volatility and so on. But I think the problem in the 2010s was that the answer was that how do you respond to these spikes? You do structural reforms. So counter-cyclical policy was really underused. So
two observations. First, the 2010s experience in India is a lesson that every country should know, and many countries go through a similar experience, which is you have to think about this. Even if you can write it like I did here as just one equation, which you can. This is just an evolution of debt. You have, or it's the complicated version of it. You have to remember that these equations involve this government paying the debt. You always have to avoid the fallacy of I'm going to increase one side of the equation and pretend nothing else changes. Okay. Economists are partly to blame because that's often how we teach. Ceteris paribus, one thing goes up, the others don't change. And that, is extremely useful, important for logical thinking. But if used wrongly, leads to bad policy. If you lower the deficit, ceteris paribus, you will be able to run down the debt. But lowering the deficit affects R, affects G, affects M. And so you may end up with actually the debt going in the wrong direction. That is an important lesson, which again would be my summary of the 2010s India that you were describing. And that is one that one always has to keep into account when thinking about these. When I was going, then what happens? All of these are interrelated. You never end up with just one or just another. And therefore, you have to think in terms of the combination, the package of policies, whether you are keeping on a sustainable debt path. So that's the first thing. The second thing, as you noted, which is very much the case in emerging markets, it's almost a defining feature of what they are, is that all of these things are somewhat volatile, meaning these deficit gambles of saying, we'll be okay for 10 years, things will be smooth, are much more risky in emerging markets because things aren't so smooth. And R's and G's and M and S's, all of them move much faster, including, like I said, the runs on the currency. Now, that is what makes it so challenging to be an emerging market, is that you need to not only think about these fundamentals, like I try to think with you guys over the last hour, but whereas if you're coming from the privilege of, say, the United States, and you see through the discussion, then you say, maybe there's problems, maybe not. We have 3-4 years to think about them. We try this, we try that. When it comes to emerging markets, these things come at you much faster, which is why I said, how would a crisis play out? Well, it plays out and starts in emerging markets. And that's why in emerging markets, the challenge of the policymaker is not only to think about these fundamentals that I discussed today, but then does not have the luxury to say, well, let's think through it in the sense of let's try different things slowly over time, but has to realize that things move much faster, and as a result has to be more cautious in their actions and unfairly often be much more constrained in the menu of choices they can choose from.
Thank you. Charan, do we have time, or there's a couple more questions? Or wonderful explanations, and this thing about how everything changes and you have to think through a lot of things. That's fundamental general equilibrium macro thinking, which is very difficult to do. Yeah, Charan, can we ask a couple more questions?
I think, he's in the middle of the day and this was his lunch break. When I asked him,
you must be really exhausted after 1.5 hours teaching, and then
so I think we'll let him go.
Okay.
And
thank you very much. It was very interesting, new insights, new ways of thinking of very, things we all think are so standard. Yeah, great.
Absolutely. Thank you very much. It was a pleasure talking to all of you. I guess I got to see a few of you through the camera, most not, but it was a pleasure joining you and discussing these issues.
So I have an important announcement to make. The recording of this presentation will be available on our website tomorrow, and I will pass on to you, Ricardo, by lunchtime tomorrow. It's been an excellent interaction. I want to thank you really profusely. You haven't changed. That same energy that I saw you in 2003 in the Harvard basement, I'm seeing it 20 years later. I'm so impressed with what you have achieved and the way you're going about. The presentation today was so beautiful. The way that you handle the policy perspective, that's very impressive, how you could step into the mind of a policy maker and think these are the alternatives. And especially your conclusion of the advanced and emerging countries, that emerging countries do not have the luxury. I think it's so appropriate. So thank you so much for agreeing to be with and talking to all of us. It's been very, 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 very refreshing interaction. Thank you. I have another announcement to make. I have another big announcement to make. We are going to have Professor Benjamin Friedman from Harvard Department of Economics speak to us on March 12th, same time. So please tune in. And next week on March 5, we have Professor Ravindra Dholakia speaking to us on inflation targeting. As you know, Professor Dholakia has been on MPC before Professor Ashima, and he has worked a lot on inflation targeting, and he will be talking to us in detail. He has also some formulas, and he also has some empirical work which he'll be sharing with us. So next 2 weeks program, next week Professor Dholakia from IIM Ahmedabad, and week after that Professor Benjamin Friedman from Harvard Department of Economics. With that, let me once again thank Professor Ricardo for sharing his thoughts and presentation, Professor Ashima to chair the session, and all of you participating on this Friday evening. See you next Friday. Thank you.
Thank you. EGROW is doing a great job. Wonderful talks you're organizing. Yeah. Thank you. Thank you. Bye, Ricardo.